Hello, everyone. I'm Alex Rawdon, Wescott's Business Development Officer. Today, I'm joined by two of our principal and senior financial advisors, Susan Green, who is also our Director of Financial Planning Standards, and Bob Waskevich, who additionally serves as our tax planning expert. Great to be here with you both, Susan and Bob.
Thanks. Great to see you, Alex.
Thanks, Alex.
So today we'll be discussing some strategies to make charitable gifts in a tax-efficient way. Bob, would you tell us a bit about our first strategy, qualified charitable distributions?
Sure. Thanks, Alex. So a qualified charitable distribution, or a QCD, allows individuals over the age of 70 and a half to make a direct transfer from their IRA to a qualified charitable organization.
Can you outline some advantages of this strategy?
The primary advantage is that you don't have to recognize income on the amount of the donation. So effectively, you're removing money from your IRA tax-free.
So is there an impact if you are subject to required minimum distributions, or RMDs as they're often called?
There is. So the donations would count towards meeting that requirement, but it doesn't increase your taxable income. So there's a huge benefit there. This also becomes an effective strategy for taxpayers who are subject to taxes that are linked to your AGI, because utilizing a QCD reduces this amount.
So is this donation then deductible on your Schedule A?
It is not deductible in the Schedule A, but you do receive a benefit regardless of whether you itemize or take the standard deduction. Also, distributions can go to multiple organizations, and they can even exceed your annual required minimum distribution as long as they don't go over $100,000 annually.
Got it. So that begs the question then, how do you actually execute this transfer?
So for the distribution to be tax-free, it has to be a direct transfer from the IRA to the charity. If someone were to take a distribution, deposit it into their bank account, and then write a check to the charity, the distribution would be considered taxable.
Well, that's very helpful. Thank you, Bob. Susan, would you tell us about another efficient way to give for those who are not old enough to be subject to required minimum distributions?
Sure. So you can actually also donate appreciated securities. So as you mentioned, this is actually especially useful for those who aren't old enough to be subject to the RMDs, but they might have some highly appreciated stock that they've been holding for longer than a year.
So then what's the tax benefit here?
So there's a double tax benefit. First, you take the charitable deduction on Schedule A of your return for the fair market value of what you've gifted. And then second, you can exclude any capital gains income that you would have incurred if you had sold.
Well, that's a great benefit both to the donor and the recipient. What does that look like in practice?
Sure. So if you'll take a look at this slide too, there's a bit of a graphic here. So say you purchased $250,000 of a security, and now cut to, a few years later, it has doubled in value and it's worth $500,000. If you sold it, so you'd owe capital gains taxes on the amount of growth, which here's the $250,000 differential. So you'd be paying the 23.8% federal long-term cap gains rate. That's 20%, but then another 3.8% net investment income tax. So you'd be paying over $59,000 to the federal government. And that leaves you with really just a net of $440 that can then go to the charity.
So is the takeaway here that it's usually more beneficial to give appreciated securities rather than giving cash?
Exactly. So if you gift the $500,000 security directly to the charity liquidates the stock and has that full approximately $500,000 to support their work instead of only $440,000. So you receive the immediate tax deduction for the full $500,000, and you don't pay capital gains taxes. So both you and the charity benefit.
Thank you, Susan. That's very helpful. What is another tax smart way to?
So there's something called a donor advised fund. It's similar to what we just discussed in terms of using appreciated securities that are held for longer than 1 year and in receiving an immediate tax deduction, but there are a few key differences. So instead of donating the security directly to a charity, you actually donate your securities to an account that's called a donor advised fund.
So are you able to contribute anything other than appreciated securities here?
Yes. So you also can contribute cash, non-publicly traded assets, so like private business interests, cryptocurrency, even private company stock. So you receive an immediate tax deduction for what you contribute.
Well, that's a great advantage to this strategy. But tell us, if you were to give to a donor advised fund and subsequently change your mind, would you be able to take it back?
Unfortunately, no. So that's the limitation. Any contribution to a donor advised fund is an irrevocable commitment to charity. So those funds cannot be returned to the donor or to anyone else or used for anything other than making the grant to charities.
Okay. Can I make gifts to any organization I want to?
Most of them, you can recommend grants to any IRS qualified public charity. So we often hear them called 501c3s, which are pretty much the majority of what you would know, but there is that slight limitation.
And how would I go about making a gift?
Logistically, you can make the grants online on your own at any time of day or night, or you can just call or email your Wescott advisor and they can do it for you.
Oh, that's very nice. So when the securities are transferred in, do they just sit there until I make my gift?
When they're transferred in, they're sold, but while you're deciding which charities to support, a lot of donor advised funds have available investment options. So you can make sure that your donation is potentially growing, resulting in even more money available to the charity in the end.
And then do I get the deduction on my tax return each time I make a gift from the donor advised fund?
That's a great question, Alex, and it's very important to note. So the charitable deduction is claimed in the year the contribution is made to the donor advised fund, not when the funds are ultimately distributed to the charities.
Got it. Well, how about bunching charitable contributions? Is that part of the strategy as well?
It definitely can be. So you can bunch charitable contributions both within and outside of a donor advised fund.
Outside of?
Sure. So if a taxpayer has an abnormally high federal adjusted gross income, AGI, in a given year, they might choose to bunch their contributions so they make a much larger gift than they typically would in one year. So, for instance, say someone typically gives $50,000 every year to a specific charity. Maybe they'll front end about 5 years of that gift and give $250,000 in a single year as a way of increasing their itemized deductions to somewhat offset that higher AGI. So the taxpayer could make the large gift directly to an organization in 1 year and then forego gifts for the next 4 years.
So interesting, though. I know many of us like to make gifts every year to favorite charities.
Yes, that's where the donor advised fund comes in. So the taxpayer could make the $250,000 gift to a donor advised fund, utilize that immediate tax deduction right away, but then choose to grant the money to the organization at a cadence of $50,000 a year for 5 years. So in practice, they're keeping up with their annual gifting schedule, but doing it in the most advantageous way.
Now, that's a great idea. Thank you so much, Susan. Bob, we've been hearing more about leveraging charitable trusts. Can you tell us a bit about how that works?
Sure, Alex. So there are a couple different types of charitable trusts. We can start with the charitable lead trust, which is an irrevocable trust designed to provide gifts to one or more charitable organizations for a specific period of time. So when that time period ends, any assets remaining in the trust would be transferred to a non-charity beneficiary.
So who can be named as beneficiary here?
It can be pretty much anyone. It can be family, your children, and a lot of people even choose to name themselves.
So hypothetically, if I named myself as a beneficiary, that would mean I would fund this trust while I'm alive.
You can fund the trust during your lifetime, but it can also be funded via your will. So you need to keep in mind that in addition to accomplishing your charitable objectives, this strategy can provide income tax deductions and estate or gift tax benefits. So your goals will ultimately drive when the trust should be created.
Well, this sounds great, but there's always fine print. What should we be concerned about here?
So this strategy requires a lot of careful planning. The charity has a right to receive payments over the trust's term. So planning is needed to ensure that the trust has enough assets to cover those payments.
Well, careful indeed. You mentioned there are some other types of charitable trusts. What are those?
So the other charitable trust is called a charitable remainder trust. This is also an irrevocable trust, but it generates an income stream for the trust beneficiaries. Just like a charitable lead trust, these beneficiaries can be anyone, including your children, family members, or again, even yourself. When that term ends, the remaining assets will ultimately go to charity.
So is a charitable remainder trust funded the same way as a charitable lead trust?
Yes. So as you can see from this chart, the donor makes a contribution to the trust, which could be cash, stock, or non-publicly traded assets. Now, when we say non-publicly traded assets, we're referring to real estate, private business interests, and private company stock. And these contributions are eligible for a partial tax deduction.
Do payments work differently here?
So the trust is required to distribute a portion of the income or principal. So the donor names a beneficiary to receive those distributions for a specific number of years. You also have the option, instead of a specific term, to tie these payments to the life of one or more of those non-charitable beneficiaries.
So here's the big question. How much would I receive each year?
So that's dependent on the type. So there are two types of charitable remainder trusts. The first is a charitable remainder annuity trust, which distributes a fixed annuity amount each year. The second is a charitable remainder unitrust. This distributes a fixed percentage based on the balance of the trust assets. Now, the IRS does require that the annual annuity be at least 5%, but no more than 50% of the trust's assets.
And the other big question, where does the charity come in?
So at the time of the creation of the trust, the donor names one or more charities that are going to receive the remaining trust assets. They can be either public charities or private foundations. So you'll notice that there is more flexibility here with the charities than the donor advised fund that Susan discussed earlier. And when the trust term is up, the remaining assets are distributed to the charitable beneficiary.
What other logistics should we know about?
So much like with the donor advised fund, the trust sells its appreciated assets free from tax, and the investment income generated by that trust is also tax exempt. Finally, the donor may also be eligible for a partial income tax deduction.
Well, thank you, Bob and Susan, for sharing your expertise with us. It's very informative and very useful. To our listeners, should you have any questions, or if you'd like to discuss any of the charitable gifting strategies we have covered in our webinar today, please reach out to your Wescott advisor. And thank you for listening.